Welcome to How to Retire on Time, the show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon or by going to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to finance, your money, all of the above, we can pretty much talk about it all. Now, that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want financial advice, you can request your wealth analysis from my team by going to www.yourwealthanalysis.com. With me in the studio today is David Franson. David, thanks for being here.
Yep, glad to be here.
David's going to read your questions, and I'm going to do my best to answer them. You can text your questions in to 913-363-1234, or you can email us at heymike@howtoretireontime.com. Let's begin.
Hey, Mike, I'm concerned about the market. Are there other places I can park my money until things settle down?
Yeah, absolutely. But if you're trying to time the market, I would caution against that. If you're looking for a solution to take less risk, I'm all for that. Let me explain why. Markets, they do crash every 7 or 8 years, but they don't actually crash every 7 to 8 years.
Okay.
And I want to say that might seem like an oversimplified, well, duh answer, but it's not true. So, well, here's a story. Guy walks into the office. He and the spouse are both planning separately. They both have their own millions of dollars. They've both done very, very well for themselves, but they manage their finances separately, and that's fine.
Okay.
So we're going through her process and all of that. He's there. He's supportive. He wants to be aware of it just in case. I turned to him. I said, well, why aren't you putting your plan together? He says, well, I don't need a financial advisor. And I thought that was so strange that two people in a relationship, they were married, had such different perspectives on how to approach their money. And I said, well, pray tell, do you get to that conclusion? And he said, because the markets crash every 7 or 8 years. All you financial advisors, you all say it. So I just invest in the market, and then I sell it in the 6th year. I go to cash, I wait for the markets to crash, and then I invest back in after the crash.
Okay.
And I'm going, well, they don't actually crash every 7 to 8 years.
It's not literal.
It's not literal. It's on average.
Okay.
So like, for example, in 1987, Black Monday, the markets crashed very quickly. Thankfully, they recovered. That came out of nowhere. It was due to computers really being traded in the market. And then in 1990, Iraq invades Kuwait, a geopolitical event that you're not going to plan on. 3 years later, the markets crash. These crashes don't matter as much if you don't necessarily need your money, because you can ride them out. But in retirement, if you need the money and you draw income from an account that's lost money, you're accentuating those losses. That's the problem. That's why in retirement, you might not want to have all of your assets at risk, because the market crashes can really sting.
Yeah. Right? So your balance has dropped because of the market crash. And when you're drawing income from a reduced balance, that's what you mean by accentuating losses?
Yeah. If your accounts go down 30%, it would take a 43% return to break even. That's fine. You can recover. But if your accounts drop 30% and then you take out 4% as income, let's say, you're down 34%. You're not down much more, but accentuating that loss causes your recovery, your benchmark, what you need to recover, as a 50% gain, 50. So taking out 4% means you need 7% more of a return. It just exacerbates your ability to recover.
Sure.
And that's a problem. They call it sequence of returns risk. And to put a spoiler alert, that doesn't mean you go out and buy an annuity and turn on lifetime income. Okay. The question, when I appreciate the question, is how do you take less risk just because maybe you shouldn't have all of your assets at risk in the market? My point being is you can't time the market. So if you think you can time the market, it's not the case. So in fact, 87 markets crash, 90 markets crash, 10 years of an incredible bull run. If you went to cash in 1997, you would miss a very significant amount of growth in 97, 98, 99.
Yeah.
And then the markets would start crashing. Great. You've got now a bias that you've timed the market, but you have to wait from 2000, 01, and 02. 3 years, the markets are going down. So you went to cash from 1997 to 2003, 2004, assuming that you knew when the bottom of the market actually was.
Right.
I mean, you could say, well, in 97, I go to cash. At the end of 2000, it's gone down enough. I'm going to go back in, and then kept losing money in 01 and 02. So this idea that you can kind of manage getting in and out of the market is tough. I mean, can you imagine 5 years of sitting in cash? Let's say you did time it right, allegedly. So the whole concept of timing the market is ludicrous, yet humans continue to try and do it over and over again. Can you read the question one more time? I want to make sure I answer this.
Yeah, I'm concerned about the market.
Which is fair.
Yes.
Very understandable, especially with the current administration and their negotiating tactics.
Yes.
The market doesn't like uncertainty.
So are there other places I can park my money until things settle down?
Okay. So in my mind, risk is, when do you need the money? It's a timeline standpoint.
Okay.
Do you need all of your money next year? No. You need some for the year after and the year after and the year after. So as I'm answering the question, I want to be very clear that maybe a portion of your assets that you would use for income, either use the ladder approach, the reservoir approach. There's many different approaches to just having some or less risk that you can tap into if the markets do crash. But having some assets that are there for long-term growth that you don't need to touch for, let's say, at least 10 years, and keep that in the market.
All right.
Because what if it takes off? You don't want to miss out. You're just trying to be more deliberate about the portfolio. So there are 7 places I believe that are appropriate for someone to put money into that would allow you to hedge against a potential market crash.
All right.
And the crash could last for 6 months, 1 month, 2 years, 3 years, no one knows. But you've really got 7 options here, maybe 8. High yield savings is one. That would be, I guess, if we did 8. So high yield savings, you've got CDs from a bank, FDIC insured. You've got fixed annuities, which are basically a CD from an insurance company. And those are the fixed categories. You know what you're going to get.
Yeah, there's like a fixed interest rate. Like, here's what you're getting. Here's the time period.
Yeah, you know what you're going to get for the time until maturity.
Okay.
Then you've got index products. Index products are a bit more complicated. If the index it's associated with goes up, you make money. You're not going to probably make all the money of that index, but you're going to participate with the upside. And if the markets go down, then you don't lose money. So you're protecting your principal. But you're participating with the upside to hedge against inflation, because inflation still exists. Even if markets are crashing, inflation can still rear its ugly head. So this is where you've got fixed indexed annuities, as long as there are no fees associated with them. So not variable annuities, not fixed annuities, fixed indexed annuities or FIAs. You've got indexed universal life, as long as you're funding it or you already have it for an extended period of time. You need 10 years to even get into these things correctly. And you have to also need death benefit. You have to have a reason to pay for the cost of insurance here. But those could qualify in this category of hedging against risk. You've got buffered ETFs. So it's kind of the securities or banking or, that side of the industry's answer to the fixed indexed annuity. And then you got structured notes. So here's how it works. Basically, whether it's an insurance company, a bank, or a financial institution, let's say you want to put $100,000 into something like this. Whether it's a buffered ETF, a structured note, this is roughly how it works. Let's say $100,000 or $1 million, whatever is going into it. Let's say $100,000 for easy math.
Great.
$100,000 goes in, and they're going to go to a bank, and they're going to say, all right, if we were to give you a lot of money, how much could we get as a fixed rate? They're basically looking for an institutional grade note. Now, I'm not trying to be fancy with jargon. Institutional grade means they're putting together millions of dollars. So your $100,000 and a bunch of other people's money to get a better rate than you would get on your own.
Okay. They're pooling it together.
They're pulling it together to get a more competitive rate. So they do that. And let's say the bank or whatever institution that's going to issue the note says, we'll give you 5.3% for 1 year. So they say, great. We're going to take $95,000 of the $100,000 of your money in this example, and they're going to put it into this 5.3% note so that in 1 year time, they know they're going to have around $100,000 cash from this note. The principal is protected. 95,000 becomes 100,000. They've got no risk. So then they take the other $5,000 with all of the other people that are pulled together, and they buy institutional grade option contracts. So basically, if the markets go up, they can exercise the contract and you participate with the upside, because if markets go up, it enters the strike price. If you don't know how options work, basically, if the markets go up, you can say, I want to exercise this contract, and you're required to sell me a price of a position or an index, whatever it is, at a lower than current market value price. And then you go around and just sell it. You made the money. Those option contracts cost money, That's why that $5,000 went to buy the right to buy at a certain price. It's complicated stuff. Some people will try and do this on their own. I think that's kind of a fool's errand because you're going to get better rates when you're pooled together with tens of millions of dollars from a group of people at an institutional level.
Sure.
A lot of these things you can get on your own. The best ones you might need to go through a financial advisor to get because they get more complicated. But the idea is simple. An indexed product with principal protection gives you upside potential, but no downside risk.
Okay.
Now, I say no downside risk. Be careful with fees. Indexed universal life has fees. Structured note has fees. Buffered ETFs have fees. Fixed indexed annuities, they don't necessarily have fees, but they might have a slightly less upside potential to compensate for the lack of fees because they got to get paid somehow. I mean, there's no one's being a charity here.
Yeah. Right.
It's just different ways to slice the pie. But these index products that offer protection, upside growth, allow you to hedge against a flat market cycle. So if the equities market doesn't make any money for 10 years, you can still keep up with inflation and growth because you make money on the upside, but you don't lose money on the downside. That hedges against a flat market cycle. It hedges against a market crash because you don't lose. You're just next year at zero again. And then as the markets recover, you enjoy that recovery. It's a way that you can hedge against what will probably be a very volatile economic time for the next 4 years. I hope President Trump does it right. But even he is at his negotiating table, has risks he's taking.
Yeah.
And so we need to be there for if it works, and we need to be prepared for if it doesn't work. And so I appreciate the question in saying, how do you hedge against it? This is how you hedge against it, but don't blindly put together a portfolio of, oh, well, let's put 60% or 40% or whatever in these protected assets.
Okay.
Put the plan together first.
Yeah.
Then put together the strategies you want to implement to be more efficient with your money, and then put together your portfolio that supports the plan and the strategies. Plan first, strategy second, portfolio third, and that's where you can then understand how much should you be putting into, we call these reservoir assets.
Okay.
Like a city that has a reservoir of water in case of drought.
Yeah.
You've got protected assets in case of a market crash or a flat market cycle.
Yeah, it sounds like what you're saying is we shouldn't sort of withdraw everything out of the money because we need some growth.
Can't time the market.
And we can't time it. So we don't know, since we can't see the future, we don't know when to put it back in, right?
Yeah, growth is important, but having some protection to hedge against the unknown is also a critical aspect.
So while we leave some in the market, we can put some in a safer spot as you listed out all those options.
Yeah, and you can get these products from insurance companies, from banks, from financial institutions, on the private markets, on the public markets. I mean, it's everywhere. But they all offer a different series or set of benefits and a different series or set of detriments.
Yeah.
So you got to understand how to blend them together because there is no such thing as a perfect investment product or strategy.
And how can we know what the benefits and detriments are? Talk to somebody like you?
Yeah.
Ask ChatGPT. Who's going to tell us?
ChatGPT is a great starting point for research. But unless you know the right prompts, you're not going to get the full context. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcast. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.